All right, it is CPI day, although this time we're going without the CPI. Our senior economics reporter, Steve Leisman, takes a look at what the alternative inflation data the Fed is kind of surveying at this point, what choices they have among those. Steve, we're probably never going to get that CPI data.
No, the White House said yesterday the CPI and the jobs data from October may never happen, or at least are unlikely. But among the alternative data that Fed Chair Powell is looking at, that he said he follows, was State Street's price stats. That scrapes millions of retail prices off the web and calculates the change on a daily and a monthly basis. It has crept up, you can see here, slowly since the president put tariffs in place, gaining nearly a full percentage point since May and underscoring the caution of some Fed officials, more about that in a second, about cutting interest rates. The good news is it's been stable, you can see there, for the 2 months. The bad news is it doesn't include services. Well, the data series itself, you can see, tracks pretty closely, the BLS headline pretty closely, though it has run a little cooler than both since the pandemic. Yesterday, Atlanta Fed President Raphael Bostic said he opposed the December rate cut in part because of survey data from businesses that his bank gathers showing intentions to boost prices. Bostic, who is not a voter and announced his intention to retire in February, said he also saw inflation spreading to those core services. CNBC now counting half of the voting members at the FOMC as either outright against or cautious about a December rate cut. Let me go through it here. Boston Fed President Susan Collins, she joined yesterday KC President Jeff Schmidt, who is likely against a December cut, having dissented at the last meeting. That's on the left there. Presidents Goolsbee and Musalam and Governors Jefferson and Cook, they've all suggested going slowly or a cautious approach to a December cut. Governors Myron, Bowman, and Waller, they're presumed to favor a cut, perhaps along with New York Fed John Williams, though he's less certain. And Fed Chair Jay Powell, I'd say right now, is unknown. Well, before Collins spoke yesterday afternoon, markets had a 64% probability on a December cut. That's now fallen to a coin toss. There's still a 69% probability of a cut by January. So what's it going to take? Likely clear data on a weakening job market and stable or declining inflation to convince the hawks to cut in December. Becky?
You know, Steve, that's kind of fascinating. I saw her comments yesterday. I did not realize it was going to kind of kick the market's probability down so low to the idea where it's just a coin flip at this point. I mean, we've been steadily moving lower after Jay Powell said that it's definitely not baked in for their cuts next time around. But this is a Fed divided at this point. Is it that unusual at an inflection point to see this much disagreement on the Fed?
I think it's pretty unusual. I think the lack of data, and by the way, one of the things you find in the market is the market doesn't agree on what data matters. And I think different Fed officials are looking at different things. Stephen Myron has his own count where he sort of insists that there is no tariff inflation. I can't quite get the backup data on that other than a paper that he cites that was issued a while ago. So I've asked them for that data. But they're looking at different things. And you're right, Becky, that Susan Collins speech yesterday really put it over the top. We have this running count that we do, and I looked at it and said, wait a second, that's now 6 of 12 voting members that are either cautious or want to go slowly or are outright against this cut. So it is an unusual split. And it has to do, I think there's some politics involved, maybe on both sides. And there's also different takes on what the risk is. And so I think this is really the key here. What you have is you have some officials that want to cut, that they acknowledge the inflation. They're just saying we need to look through it. Others are saying, no, we've been above our target for 5 years now, and we should not be looking through it. And there's a lot of concern among those members that the Fed's target is not going to be taken seriously and that the market's going to get the impression that it's not 2% anymore, that it's 3% now.
I was going to just suggest, Steve, not definitively, that even if we had all the data that we're missing, I don't know if it'd be that much different, really. I still think that there's so many, differing forces in what's happening. It's always uncertain. They never know for sure what to do. But it even seems like there's more reason. I can easily make arguments that everything's going to be fine on both mandates. And then I can make arguments that it's just the worst we've seen since the misery index of, long ago. right now, that we've got major problems in both things. So I could argue either one, with productivity and AI and all these different forces. Is it different this time? Is that what I'm getting at?
If you're personally divided, how do you expect the Fed to come to a decision?
That's what I mean. Even if they had the data, I think they'd be. Yeah.
When I'm asked about this, Joe, I say very definitively that it takes a definitive jobs number. You need to show a really weak jobs report. I think would take some of those who were slow and cautious, bringing them over to the rate cut side. A solid jobs report. The other thing we don't talk about a lot is that the data that is being gathered and estimated suggests the economy is fine. And there are several of them. I think Susan Collins was one of them who said, wait a second, the stock market is a tailwind for this economy. And it's hard to look around. Several officials have said this, to look around the economy and say, well, which part, other than, of course, housing, is really suffering from rates being too high? I think there's a concern here that they go too fast and they end up fueling inflation.